we're going to have a session here on founder wealth in the AI era. Every cycle in tech creates wealth, as we know, but the AI cycle is doing it faster and often in more concentrated ways than we've ever seen before. Founders are hitting meaningful scale on compressed timelines. That raises a different set of challenges because building wealth and managing it are two very different skill sets. So, fun fact, Adam is a former New York State arm wrestling champion. We're not going to do that.
Another reason my daughter thinks I'm pretty cool.
Does she challenge you to an arm wrestle? Yeah. So that's
She's a lefty.
That sport is all about quick reflexes and explosive strength. In the era of AI, founders are building these massive piles of wealth at absolutely lightning speed. From where you sit, and you've been a founder as well as an advisor, what is the biggest danger of moving too fast when it comes to managing that wealth?
So, I always like to create contextualization for anything coming out of anyone's mouth. So, just real quick. So, Corient, a lot of people don't know what it is. I feel like on this stage, everyone knows who everyone is. I've got to be the first person that no one knows who I am at all. And it's funny, I was at another event yesterday where I was bookended by Ray Dalio and David Beckham.
Wow.
And today, I'm by pretty much the smartest people on the planet. I'm starting to feel like it should just say, comma, bathroom break, which has nothing to do, has to do with me. So I'll try to create a little entertainment. So Corient is client-oriented. We clearly went a little heavier on the orient part. If we added the L, it would have been Chlorient, which would have sounded something like a detergent of sort. We are, as of Monday, the largest non-bank wealth manager on the planet.
Wow.
Which a lot of people are like, I didn't know that. $500 billion. We're a private partnership, which is super unique and super fun. No matter what door you knock onto the building at Corient, you get access to the whole building. Not every firm works like that. You get sort of trapped in the room of the person who opens the door. I run the entrepreneur and founder practice, which means any entrepreneur or founder on the planet, they could be in Africa, they could be in Europe, they could be in Asia, they could be in Canada, or they could be in the US, will meet me and have the collective wisdom of everything we've done. So we work with hundreds of founders. So as I start giving you some answers, there's a lot of context, did it myself as a peer and as a provider. I think one of the biggest problems is with all this explosive growth is people suddenly have so much visible wealth.
Right.
And we live in a Zillow world, as I say, where people can pretty much look up almost anything. So as a founder gets new wealth, they have to be really, really cautious about what's above the surface, which everyone can see, and then what's below the surface and what's left. What you don't want is a popsicle stick, because from the surface, the two look the same. But over here, this could be a full iceberg underneath, and up above, there's not so much transparency. So we try to be really mindful about making sure to not do too much too fast,
right.
And also make sure you explain your why, not just the what that people can see.
So with this acceleration, and in some cases, liquidity timelines also being accelerated, how is that changing the way founders think about wealth earlier in that journey?
I mean, information, symmetry has changed so much with obviously this whole conference in AI. So founders are getting super, super smart around the speed at which things are going, that especially in the AI space is parabolic. So some of what I'm going to talk about sort of IQ-y, sort of like structural, and some of it EQ and psychological. On the IQ-y side, what they're doing a lot right now is making sure they're starting the company in a structure like an LLC and converting to C Corps. And the reason I explain that is a lot of you probably know about qualified small business stock, QSBS. If you do this the right way, because of how fast these things are accelerating with value, by starting as that LLC instead of the C Corp, you're able to get way more than that 10 million or now 15 million as of last July. That's a really big structural change. I've been working with founders since sort of the end of 2010 when QSBS really became more well known. So that's a big new thing that they're doing. The other thing is people are getting bought so quickly. Mm-hmm. Usually the timeline is that 5 years for the hold for qualified small business stock. It's gotten truncated a little bit on a sliding scale as of last July with 3, 4, 5 years. I'm working on a lot of deals right now where people are selling in 1 or 2 years. So they're being really smart about the tax efficiency of that. So I would say those are some of the things that we're watching a lot in terms of the inception formation and then the mindset of not losing these great tax perks.
But with that speed, there is uncertainty. Mm-hmm. So when you're looking at this and you're advising people, what distinguishes the founders who are building durable wealth
Yep.
versus those who don't?
Yeah. I think about a concept we all remember as a kid is, remember you had a maze, and one day you finally realize if I start with the word finish and go backwards, it's a lot easier to solve it. So the founders that we work with that have backwards mazes, they think 10, 20 years ahead and jump back. And they realize that if they can start creating a ballast to this parabolic growth of their own company, they're able to go after the company with more gusto, and they're able to be calmer. So a lot of them take out secondary every single time they can. I tell people that I have no one who regrets selling and countless that regret not. Because if whoever bought your secondary is right, whatever's left is going to be worth so much. And the utility at the margin of those dollars in the future over your liquid denominator versus today is radically different. So by doing that, they're able to totally be long-term. Their investors love it because they're not focused on getting liquidity because they have it. The only mistake sometimes people make is they just start angel investing with all of that money instead of creating something boring.
But it's sexy to do that.
Of course it's sexy. And it's illiquid, and then unfortunately it gets correlated into one.
Right. So you advise at least 100 founders, maybe more, right?
I try to not say huge numbers because it doesn't sound intimate, but a couple hundred.
Okay. Oh, a couple hundred.
Well, we have a big team.
Yeah. All right. So tell us what have you learned about the most forward thinking of those founders today, financially or strategically? Yeah. What sets them apart from the ones who aren't?
I'll start with the strategic. I always talk about that time machines exist. Nothing that anyone's invented on the stage yet, but in your head. And if you look at the next decade and you say, hey, is the next year 100% of time or only 10% of the next 10 years, time moves slower. So I think historically, the folks that had time arbitrage to their side were able to just move with much more patience. Something over the next month didn't feel that urgent. I think on the flip side, there's founders right now that look at the next year as actually 300% of what time used to look like and actually understand urgency. And why we can't really invent more hours in the day, they're using things that we've been talking about on this stage to invent them. I think on the really specific financial side, something that's been missed a lot is because things are moving so quickly, a lot of folks historically had a cliff vest with their equity for the first year. And the problem with that is you can't gift stuff that's not vested into a trust. So even if you take some election that tells the IRS it's my property, something called an 83B election, the other part of the tax code doesn't care. That has to do with gifting. So by having some of your equity vested immediately, it allows you to start moving stuff into different structures that gives you massive optionality at an outcome, especially for multiplication, or some people like to call it stacking, of qualified small business stock.
Right.